And Youssef, please go ahead, followed by Adam Siemiński.
Thank you. Well, thanks for the speakers for the amazing outlooks presented. Just would like to, I do some research related to oil markets for our consultancy markets, and I also do some research at Imperial College in London. And one of the things that I'm not sure about and I would like to hear from the experts is that for what is the new demand elasticity? Because now we're seeing prices exceeding $90. And as you know, continued rise in prices can be detrimental to demand, but currently we are in a recovery mode. So what do you think is how elastic the demand will remain? Is it $100 or even higher than $100? And what the other thing is, if the Fed decides to raise interest, and they are expected to do so in March, so what could some analysts are expecting some sort of an economic damage, like Mohammed Al-Aryan and others. So could that have any, what would that mean to oil markets? These are the things that I trying to better understand. So if you help me analyze these things, I'll be very grateful.
Okay, it's a great question. You know, let's go to Adam. And if you have any insights into the future trends of price elasticity of demand for gasoline, diesel, heating oil, please go ahead and make a comment. Adam, please go ahead.
Thanks very much, Vince. That was a really great set of presentations and questions, and I'd love to hear the answers to Youssef's questions, which I thought were really pretty interesting. Price elasticity of demand as prices rise. I mean, we should see some impact lowering demand there, and I think that's right that interest rate hikes should lead to a little bit of a slowdown in GDP. And as Ed was saying, there is a relationship between GDP and demand, and that would lower demand too. So maybe we need to be careful about what happens on the demand side, particularly, I think, maybe as an offset to the concept that the missing barrels end up showing up as higher demand rather than something else. My question, and I'd be happy to have the discussion go back and forth between Youssef's question and this one is there a political premium in $91 Brent? And if there is a political premium, is there any way that you can quantify that? You know, is it $5 a barrel or $10 a barrel or something more or something less? Thank you.
Okay. Any comments, any answers?
I'd like to take a stab at some of both of them. First, on the demand issue with higher prices and higher rates. So the two go together. Higher rates bring about an appreciation of the US dollar. And that is another really big headwind for emerging market growth, in addition to the other headwind, which I talked about earlier, namely China's slowdown and the impact that has on emerging market exports to China. So there's no doubt that there is going to be compounded damage to the global economy and to growth by the combination of the two, namely higher rates and higher prices, combined with the foreign exchange impact in emerging markets. The other issue, we tried really hard to look at the risk premium in various assets. The easiest way to do it normally in oil is to look at what I alluded to earlier, the long-short ratio of managed money and their movement. So if they go to like twice or three times the level of the average, there is no doubt that there is a significant impact on prices, and you can, at various levels, depending on where the price began, look at the inflationary impact on prices. And similarly, if the market goes short, and short is not going short, but is going under the normal length, because for technical reasons, managed money is always long. It just can be shorter than the normal. It has a depressing impact on prices. As I mentioned earlier, there has been no sign from financial flows per se, looking at managed money, that Brent is seeing managed money inflating the price of oil above where it otherwise might be. On the other hand, if you look at various other aspects in the market, including volatility and the way implied volatility has behaved as a function of the supply and demand for options, we do come to a very strong conclusion that there is a risk premium at the moment that is definitively associated with Ukraine. You can look at the relationship between volatility and Google search items on Ukraine, Russia, and they happen to coincide, and other secondary things that you can look at. And as I said in my opening remarks, we think it's a minimum of $5. Hard to say whether it's more than that, but we know that before the most recent increase in these tensions, prices were falling off. And we know from other indicators that high frequency indicators of where demand is and where supply is, that this should be a softer market than the market was when prices were $5 lower. So I can believe that it's between 5 and 10, but there's no real scientific way that I'm aware of actually measuring it.
Yeah, we have a question from Mark Finley sent through the chat, so please take a look at it. And Anna